Welcome to Morning Brief on Yahoo Finance. I'm Julie Hyman. That is Miles Udland, and it's Fed Day.
It is Fed Day.
At long last, the long-awaited Fed meeting that we have been talking about. And today, obviously this Fed meeting itself is not going to be that interesting, but today is the day when Fed meets oil, and we, continue this conversation about what effect these higher oil prices will have, whether the Fed will look through, as the parlance goes, look through this oil price increase and, not do anything about rates, not just today, but for the next few meetings. We get a new dot plot, a summary of economic projections, although there's some debate about how much credence we should give to that. There's always a debate about how much credence we should give to that. It's even more today. So there's a lot of different things to sort of parse through, but, feels like we're not going to see a change, but we're still going to keep talking about whether there's going to be a change going forward.
All right, let's take a step back because, first I will save my pressing on this insistence that this is not an interesting Fed meeting, which is not just your take, but now is coming from various Wall Street desks. But we'll save that. Just before, okay.
It's not interesting from the perspective of current setting of monetary policy.
I disagree.
Okay.
But later. Okay. So I think what surprisingly will set the table for the Fed meeting, and we were literally joking about it 40 minutes ago because the data came out 10 minutes later, which is the producer price index for February. Let's call it the junior inflation report, right? CPI, consumer prices, is where we spend most of our attention. PCE, another read on consumer prices that the Federal Reserve prefers. PPI this morning coming out, showing that prices rose more than forecast across a range of goods and services. And I believe we have the tweet from Kevin Gordon over at Schwab, who broke down some of the major increases across a variety of services, which really kind of hammers home the pressures we're seeing that I think are going to be challenging for the Fed to deal with, which is why this is both an interesting meeting and probably an interesting future for the Fed in general. I'll pull it up here for my own reference. So in February, year-over-year increases, these are some notable categories which feed into PCE, so we're likely to see them later, but I think they also just speak to some of the pressures in the economy generally. 6% increase in scheduled domestic passenger air transport year over year in February. Airline ticket prices going higher. Hospital inpatient care up 4%. Hospital outpatient care up 1%. Nursing home care up 2.9%. Home health hospice care up 2.8%. Theme there, of course, we've talked about it with the labor market. Healthcare is a big source the only source really of employment demand. Obviously, it is a source of pricing pressure. And I looked back at something that Powell said, Jay Powell, Fed chair, just for posterity.
Just in
case we didn't know that. In January, talking about inflation, saying that elevated inflation readings largely reflect inflation in the goods sector, boosted by the effects of tariffs. Next sentence, in contrast, disinflation appears to be continuing in the services sector. This is not totally contradictory to a disinflation narrative, but I think it challenges perhaps some of the idea that inflation, which we discussed with Josh Schaefer yesterday, is not that's not the main thing for the Fed. It's going to be the labor market this year.
You left out the thing that contributed the most to inflation last month on the wholesale level, financialization. That is portfolio, right?
Yes.
So it says it in the release, 20% of the February increase in the index for services for intermediate demand, so not the good stuff, the services stuff, was because of prices for securities brokerage, dealing, investment advice, and related service. That wasn't news. This is something that a lot of economists have been flagging here. But I just thought that was interesting too, because of this increasing tilt in our economy towards financialization of everything into, everybody being in the markets. That I guess that area of the market has pricing power.
Yeah, and that typically is a pretty mechanical representation of activity. Essentially, there's inflation within the cost of the services sometimes, but it's usually just how much more activity was there this February versus previous Februarys. What was the nature of that activity? Obviously, the two of us, if we need to do something in a brokerage account, that costs essentially nothing now. Right. So it's the more bespoke services that we can offer, or that firms are hoping to offer around the edges of that. But let's go back to the Fed meeting today.
Yes.
And specifically the idea of both the interest in, the Fed's not going to cut rates today.
Yes.
And we know, I think, the Fed's not going to cut rates in May. because Jay Powell is not going to be cutting rates
That's
so
right.
long as he is the Fed chair, and it is expected that this is his second to last meeting. But I think the reason why this Fed meeting is particularly interesting is because it's, in May it'll be processional if we have some clarity from the Senate, Kevin Warsh's appointment, confirmation, et cetera. But so in some ways, this kind of feels like the actual last Powell press conference. This, to me, feels like it's going to mark the end of the era because technically, he's not lame duck yet. There's been a nomination, but there's been no movement on confirmation hearings for Kevin Warsh. Now, we expect that will be the case.
Okay.
I feel like this is it for Powell.
So why is that interesting? So connect the dots for me.
Okay.
So I take your argument. That's fine. We can call this Powell's last real meeting where he could say something that would. But what's he going to say that's going to be interesting? I mean, he'll talk about how he's thinking about and how the committee is thinking about these oil prices. Obviously, he'll probably get some more questions about the subpoenas that the Federal Reserve received that were thrown out. To which he will say, I'm not going to comment on that. So, what are your candidates for interesting commentary today?
Well, Powell has, by far in the last decade, well, I shouldn't say decade, since Paul Volcker, Powell has had the most dynamic inflation environment to navigate as a Fed chair. So not only will his comments on today's inflation report, yet another surprise in the Powell era, be notable, but I think where inflation kind of what the send-off is for inflation economy-wide as Powell exits the chair, that's the end of the markets receiving and kind of contemplating most closely his view on how he interprets that inflation, which has been largely a willingness to look through, and then it became a very quick willingness to not look through inflation. And he's, I think a lot of people in the market would argue that he's been late in both directions. I would argue that he's kind of just been consistently timed in both directions, whether that's late or not. It was a similar kind of patterning. And as we enter a new era of the Fed, where the inflation problem, as it were, does not appear to be fully solved, I think it's just worth noting, like one for the road. Hey, here's what the consensus was. If you really care about the Fed on how you want to be right, you want to be wrong, do you want to be in agreement with, disagreement with the Fed, this is the last time, really, that we're going to get that view from Powell. And now we've got to kind of warm up to an entirely different way of communication, an entirely different worldview, I think, from Kevin Warsh, which will take some time for the markets to kind of get into. I mean, it's been 8 years. It's been a very long time that we've had Powell in that seat dealing with these dynamics. And there's a way that you can anticipate how he's going to approach some of these things that, will take some learning with Warsh. You're not sold.
Not entirely convinced. It'll be interesting because we're always interested in the Fed. I don't know that it'll be any. I don't know. I'm not convinced on that. I mean, and when you say that the market feels, I sent this study to you from 22V Research where they asked survey respondents. They didn't ask whether they were interested in the Fed and what he's going to say. They asked what the market reaction would be to the Fed, and the majority of them, 79%, said the market reaction to today's FOMC will be mixed or negligible. In other words, there won't be much of a reaction.
Sure.
So that
so you're kind of adopting my worldview in some ways, which is the only thing that matters is what moves the market. And so if it doesn't move the market, ergo.
It matters because we like to talk about it.
Sure.
But it matters more, if it moves the market.
Sure.
That's
all right. Couple cleanup items on the Fed before we move on here.
Do it.
Let's bring up Claudia Saum's tweet. Her suggestion around how the Fed should or should not view their economic projections, which, to be clear, are expected to come out today, and Claudia expects them to come out today. But drawing the parallel to March of 2020, when the Fed suspended their economic projections right at the height of the pandemic and kind of looked at the current economic environment and suggested that they consider doing the same. Now, again, Claudia followed up and said they are definitely going to release these today. But it is a thought experiment around, is this the kind of environment in which the Fed might consider changing its communication?
Well, and I mean, there has been sort of the knock on the SEP for a while, the dot plot for a while, that we should take the thing with a grain of salt. I mean, Jay Powell himself has said, like, don't pay too much attention to this thing. And the market doesn't pay attention to him and instead invests too much meaning in it. So is it time I mean, you could make an argument, get rid of the thing entirely, as some people have. There was an opinion piece in the Wall Street Journal which made all kinds of suggestions for Kevin Warsh to what they said was depoliticize the Fed. They said get rid of the press conferences. Let's go back in time. I can't get on board with that. But I do wonder about the actual utility of the SCP at this point. Is there such a thing as too much communication, it being too granular, and then us obsessing over, each dot, whereas that doesn't really, is it useful to us? And I'm not convinced that it is that useful.
Well, selfishly, I think it's very useful. I think it's great. I don't want to go back to a time when there were only 4 press conferences per year.
Right.
And I've always enjoyed the SEP. I think in theory, not having to show your hand, as it were, would give you flexibility to change your mind on the fly. I actually sort of think in practice, having the SEP as a benchmark to either lean into or steer away from gives the Fed and various Fed officials and market participants, folks like us talking about it, a lot more guidance and a lot more latitude, frankly, I think, to change your mind. Like, I think if you are a Fed official who is not publishing a dot plot 4 times a year, it's just going to be harder, I think, for both yourself and people listening to you to be like, okay, can you benchmark this for me? Where do we start from again?
So you don't like just relying on Fed speak, for example, and the speeches that they make.
I understand the idea of, when you benchmark yourself to, people say it's like, okay, don't make a conservative goal because then that's going to be your ceiling. All these kinds of life advice ways that you shouldn't give yourself benchmarks. And so that's the idea that I think is appealing to policymakers in some ways. But I think that in practice, it just sort of leaves everyone, including the Fed themselves, those officials themselves and their teams, kind of just unmoored and out in space and have a place to...
Where was my dot again? Let me look at the dot plot to remember what I think about monetary policy.
My view on it.
Maybe, I don't know. All right, do you have another item or can we move on?
Well, we have a perfect segue here.
We do.
You do it.
As we're talking about transparency,
yes.
We might as well move on to the Securities and Exchange Commission and some stuff that they are doing and that they're reportedly doing. I mean, really on the transparency side, there is the report from the Wall Street Journal that the SEC is considering no longer requiring companies to report 4 times a year, quarterly, that they can report 2 times a year. And this is something that President Trump has floated before. This is something that some companies have pushed for. They say those regulations, the cost of reporting every quarter is just so onerous for them to do. In Europe, they only are required to report twice a year. So it would be, because we have been talking so much about wanting to emulate the European regulatory system and economy, why not follow them on this particular item? I think, we as journalists, it's obviously helpful to have a company report 4 times a year. I understand the allure, not so much like the regulatory burden of reporting 4 times a year. I get the argument that this causes companies to not, and the market to not focus as much on the long term. They focus too much on the short term.
Yeah.
I get that argument. I think I would be sad if companies didn't report 4 times a year.
It seems pretty clear that the rule is going to change, right? I mean, the report is that there's likely to be, what is the word? They formally put out the process, call for comments, essentially. Solicitation, I think, it might be the right word. So that's going to happen, and it feels like this is going to be a change that happens. Now, as I've thought about this, I sort of don't think every company is going to follow the new rules right away. I think a lot of companies...
Or ever. There will still be companies that report quarterly.
Yeah, because I think that for all the downside, and I've heard, I'm sure we've all heard CFOs talk about this. You report 1 quarter, you basically take a week, you can go to the lake house or whatever. You start reporting the next quarter right away. You all of a sudden move into gathering all the data you need to, et cetera, et cetera, et cetera. And you spend 4 weeks before the call prepping your comments, et cetera. It is a huge burden on executive teams. On the other hand, I think that well-run businesses have enjoyed incredible leeway from the markets and seen tremendous returns for their shareholders, and their customers and businesses, executives, et cetera, as a result of being public companies and reporting 4 times a year
right.
and telling the market all these great things happening within their business. So companies may choose not to, do 4 times a year if they don't have to, but I sort of suspect that it will not immediately go away. And I kind of think it'll end up being an advantage for some companies to continue to come out with the
I think that's right. And this argument that companies don't want to come public because they're going to have to report 4 times a year.
Yeah.
I think you're right that some companies are going to tell on themselves by not reporting who's going to be overjoyed to not report earnings 4 times a year? Elon Musk.
So I knew you were going to say that.
He's going to love it. Are you kidding? Alex Karp? These people who, I guess what I'm saying is what I like to think of as the faith-based stocks.
Yep.
And that's not to say that these companies, Palantir obviously has shown real actual growth.
Yeah, same with Tesla. We know what you're saying. Yeah.
But they don't need to report 4 times a year to drum up the base.
Well, here's a question. We'll see what it comes out with. Could you do a quarterly report or an interim report that it doesn't have the same full auditing? It's not the same breadth, right? Because I think that to use those 2 executives as an example, while they both like to complain and have complained and often, almost every quarter, complain about the
haters,
the ritual. No, but they do like the platform.
They do like the platform. So maybe they'll still have a call
understand as much
quarter.
as anybody the value of having that communication channel.
Sure.
So I think they'll certainly have the call. They might have more calls.
One of those guys has a communication channel that he owns that he uses a lot. But yes, to your point, it's a different kind of tone that he strikes, and it's a different kind of communication with investors. The other thing that the SEC is doing, it's not waiting to do, it is doing. Paul Atkins, they issued an interpretation. And this has to do with cryptocurrencies, and basically they now are saying there are 5 different types of crypto tokens: digital commodities, digital collectibles, digital tools, stable coins, and digital securities. And federal securities laws only apply to digital securities. Is that clear? Are we clear now? Is everything okay now?
Crypto was more fun when it was just talking about the prices going up. That's it.
Well, that's the funny thing about that is, for years, this is what the industry has wanted. They're so excited about this. They're so excited that Paul Atkins is there, and they feel like they have an advocate at the SEC who's making these new rules.
Yeah.
But to your point, crypto being more institutionalized probably means at some point it'll get more boring, and not as many people
I think we're there.
I think we're there too, right?
We're there.
Yes, we've gotten a little bump in Bitcoin since the war began, but it's still a sideways move, right?
Yeah, I think you want it to become just another asset. Now you are.
What you wish for.
All right, let's talk about some executives. It's a Wednesday in March, so it doesn't feel like it would be the day that you are taking the biggest job of your life. But if you are Josh tomorrow, that is the case. In about 3.5 hours, he will be the CEO of Disney. And it comes at a very interesting time for the company. And it'll bring up one of my pet points, which is that Disney is the #1 company that if you went and asked someone on the street, how's the stock do, people would get it wrong. Because this is a company that has basically, in the last 10 years, doubled their revenue. They've roughly doubled their profits, roughly, a little bit less than doubled. Mm-hmm. And the stock has done nothing. Now, pay a little bit of a dividend, and you've got some buybacks. It hasn't been a total zero for long-term shareholders, but it's certainly underperformed the S&P 500 over that time, and the stock has not performed up to the perception and actual results of the company.
Yeah, I'm sorry, I'm distracted because I'm looking on my Wi-Fi interactive to pull up a chart of Disney, which I now have. Can you guys take a look at the interactive here? So here's the 10-year chart of Disney and the sideways movement that we have seen. So here's the 20-year, and so this more clearly shows you that it's gone sideways over that. So yeah, it has been a solid 10 years. Yes, you had the sort of little bit of a rally there that it had post-pandemic, but otherwise that's the movement. I guess I was thinking about this a little bit because I was thinking about the discussion that we had a while ago about retail and how there are certain companies that you have an emotional connection with. Mm-hmm. And Disney is the example of that from a consumer perspective because of that perception that that person on the street has. They take their kids to Disney, they're watching Disney Marvel movies and whatever else, and Moana and all the things.
Clubhouse.
So like there are there isn't that emotional connection. So I think that's why that people would assume that the company's stock had been doing a lot better than it is.
Yeah.
And yet they would have been wrong.
Yeah, I mean, I think it makes the case for, indexing. It makes the case for indexing, and the reason is not because it's a bad company or it's a bad stock, but that you can actually be right. The business grew, the profits rose, the brand has and there's been some hiccups here and there, but overall an impeccable reputation in the market. Everyone loves Disney generally, and yet the stock did not meet the performance of the index that you could have gotten for basically free elsewhere.
Yeah.
So that's it. That's my little soapbox on Disney.
Well, so then the question is, what do they I guess
they're going to break the company up. I think.
Feels like that's what needs to happen.
That's what's going to happen.
Yeah.
Fiscal 2015, 52 billion in revenue. Fiscal 2025, 95 billion in revenue. 94.4 billion in revenue. So
it's pretty. It is pretty incredible,
huge
isn't
company.
it? I mean, so. Do we want to talk about other CEOs?
Yeah, let's do one more CEO.
Okay, can I pick? Do I get to pick?
Oh, you're going to pick the CEO. Okay, fine. I know which one you'll pick. We can table the other one for tomorrow.
Which one are we tabling?
We'll table Tim for tomorrow.
Okay,
let's do Apple tomorrow. Let's do Lulu today.
Let's talk about where there's not a CEO.
Okay.
And that is indeed Lululemon. So Lululemon just put Chip Bergh on there, or they're nominating Chip Bergh.
Another
to the board.
Chip. I was like, how many chips are going to be associated with Lululemon?
We got Chip Wilson, who was the early Chip, who then exited the company, and now we have Chip Bergh, who was former CEO of Levi's, who is being added to the board. He's not the Chip Wilson pick, by the way. He's a different.
In conflict with Chip.
That's right. Chip v. Chip is what we seem to be having at
like an NVIDIA trade within Lulu.
I mean, this comes after a quarter that was pretty meh for the company. China is apparently doing great, but North America continues to kind of just stumble along, I guess, here. The people who Chip Wilson wants on the board include people like Mark Morer, who's the former CEO of On. Who knows if he's pushing for him to be the new CEO. But the bottom line is that Lululemon has lost its mojo. Is Chip Wilson the guy to bring it back? The original, the pants are not made for everyone guy? Mm-hmm. I don't think so. I mean, I think he's got an awful lot of baggage. And so the fact that he's the one who is now pushing for some of these changes at Lulu, I don't know what those changes would look like. But he's saying that the company there's a disconnect between the company's creative engine and the board's understanding for how brand power and product excellence fuel cultural strength, blah, blah, blah. I don't know what any of that means.
Well, Chip Wilson's a founder.
Yes.
So I think that brings back into play a different story for Lulu, both operationally and I think for investors, when you have the founder back in the fold. If he were to more materially come back into the fold. Yes, right,
because for now he's just on the outside poking at them to see what's going to happen. I mean, they have had a series of, they've grown a lot, right? They've grown their sales a lot, but they have had a series of various CEO mishaps, shall we call them, over time.
Leave it at that.
So we'll see
the stock didn't go down 20%. That's a win.
That is a win.
Down 3% this morning.
Down a little bit.
There you go.
All right, that does it for Morning Brief, and we've got Opening Bid with Brian Sazzi next.
Good Wednesday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. Before I go all in on Fed Day analysis with my esteemed roundtable of guests, a few things I want to get off my chest right now. One, if I look a little tired, it's because I spent 50 minutes last night interviewing Circle CEO Jeremy Allaire at the New York Economic Club. That was indeed fun. I'll have a story hitting the Yahoo Finance homepage shortly on what Jeremy told me about his surging stock price. But I will say this bluntly. Jeremy left me absolutely terrified on the outlook for jobs because of AI proliferation. Epic job market changes aren't 12 months away. Jeremy told me he thinks they are months away. Bottom line, go learn something related to AI today. It's probably in your best interest. 2, good to see retail goat Chip Bergh joining the board of ailing Lululemon. You can see me chatting with Chip back in late 2023 at the Milken conference before he retired as Levi's CEO. There we are on the screen right there. Chip rocking his black leather jacket, very Jensen Huang-like. Lululemon needs some real leadership, and the former longtime CEO of Levi's is the guy to bring it after another weak earnings report and Elliott Management lurking. Fun fact here, Bergh created the Swiffer mop while he was an executive at Procter & Gamble. That's what we call news you can really use. And 3, I like seeing that the market has started to slowly decouple from oil prices. What I don't like, Citi out this morning, not ruling out $200 a barrel oil prices. This call out getting a lot of my attention on my X account right now. I'm just reporting the news. I didn't write this research report. That's their call. Here on my opening bid roundtable, Victoria Fernandez, Crossmark Global Investments Chief Market Strategist, alongside Yahoo Finance reporters Jennifer Schomburger and Jake Conley. Jake, I want to come to you here. You're new to the opening bid roundtable. This Citi note that I got this morning, they didn't say, hey, look, we expect $200 a barrel oil prices, but they weren't exactly saying oil prices going back to $70.
Yeah, Brian. I mean, even just look at the action today. Brent futures already up 7% since midnight to trade at 108. US WTI futures up 5% to trade above 97. Several different headlines moving this market. Attacks on the gas fields in Iran by Israel. Iran has now published a list of energy targets in the Gulf it wants to go after in retaliation. Confirming the security minister, Ali Rajani, is dead. Israel saying it's now killed the intelligence chief. Essentially, this conflict is not slowing down. And all the analysts I talk to say that we could see higher oil prices than we are right now. One thing I want to call out, if you look at the physical market, remember Brent, WTI, these are futures. You look at the physical market, barrels in Dubai, barrels in Oman are trading around $160 a barrel. That's a $50 premium over the Brent futures market. And the analysts I talk to say that could be a sign that the futures prices we're seeing and talking about could be far, far lagging what's going on in the physical market and could need to come up significantly to get there.
Jen, good luck to the Federal Reserve in trying to incorporate all of this into its statement, its press conference without spooking the markets. I wish Jerome Powell well. I wish him well.
Yeah, well said, Brian. And for that reason, I am not expecting any changes in that so-called dot plot, those interest rate projections. I think there's so many things going on with the uncertainty right now in the economy, whether it's the impact of the Iran war and the oil price spike, AI on the job market, you name it. There's so many things going on that can go in so many different directions. And for that reason, I think they're going to just retain the one rate cut that they penciled in back in December, because at this point, they're just making an educated guess. So I don't think we can put much stock in that dot plot today. I will be looking at their outlook for inflation. I expect them to revise higher their outlook for headline inflation. I will be looking, however, to see if they revise higher their outlook for core inflation. And for that, I will also be looking to Chair Powell during the press conference to see whether they are looking through this oil spike and how long oil prices will need to remain at elevated levels before they see that trickling into core prices and would need to take action accordingly. That said, you talked about the policy statement. We learned in the minutes from the January policy meeting that there were several officials who were already looking at making changes to the policy statement to make their language two-sided. That is to say that if inflation were to remain above the Fed's 2% target longer, then perhaps they should be factoring in the notion of a rate hike. I would imagine that's coming up in discussion again in the policy meeting today. The question is whether that ends up in the policy statement today.
Victoria, let me get over to you here. It was amazing. Coming into this year, we were looking for rate cuts. Now we got people talking about a potential recession and rate hikes. Has the market, in your view, adjusted for this? In my humble view, it hasn't. I mean, we're still kind of hovering or clinging around to all-time highs on the S&P.
No, you're right. I think this market really is just kind of thinking we're going to get through all of these elements, whether it's what's going on in Iran, oil prices, inflation, weaker growth. It seems like the market thinks we're just going to be able to get through this because the consumer is going to keep spending and all will be fine. And so it's not really repricing to the level that you would expect it to see with all of these uncertainties going on. We have priced into the market the one rate cut. And as Jennifer mentioned, I don't think we're going to see the dot plot change that tremendously. I don't think we're going to see changes in the unemployment rate coming out of the Fed, but I do think that it is key that they mention whether they're looking at this as a pass-through or whether they're actually going to put it into their expectations going forward. I think at this point they can't completely ignore it, and if the Fed becomes even more hawkish, then I think perhaps we start to see the market react. We are just now seeing other central banks start to hike rates, right? We saw at the Reserve Bank of Australia. You're looking at what's going on at the ECB and the Bank of England. They're looking to potentially hike at coming up meetings. So there is that precedent there that could put a little bit of pressure on the Fed to be more hawkish than perhaps what people are expecting. That could cause some volatility.
Victoria, I'm going to resist my urge to ask you about this city call for potential $200 a barrel oil. I'm going to sweep it to the side because I'm still thinking about this convo I had last night with Circle's co-founder and CEO, Jeremy Allaire. We went into a lot about how AI will shape the labor market over the next year. Of course, the labor market, a key factor in what the Fed does or doesn't do on rates. Victoria, Jeremy left me absolutely terrified. He thinks unemployment is not going to only just spike 12 months from now. He thinks we're like headed right into this, and we could see a lot more layoff announcements. How concerned are you that this is not being factored into stocks?
Yeah, it fits into the whole Citrini research piece that came out, and there was a market reaction immediately, and then everyone pulled back and went, oh, this is just, kind of like make-believe. It could happen, but it's not really going to. This gives you another data point now. There's more people out here that are saying, wait a minute, this could be more reality than fiction. And I do think it's concerning when you look at college graduate unemployment rates and how high that's going. There's a deep concern there as to what that means across the board for our economy, because it filters through to everything, not just consumption, but household building, building families, what that means in terms of spending across the board. There's a lot of follow through to this. And so I think it is quite concerning and something that we should be looking at when it comes to growth expectations and what that means in terms of earnings expectations. Brian, we've still got 14%, 16% earnings growth expectations for this year and next year. I think that's going to have to start coming down based on some of these reports.
Yeah, I think those estimates are absolutely useless, but we'll take that offline.
Right,
Victoria, Jennifer, and Jake, thank you so much. Appreciate it, y'all. All right, as we wait for today's Fed decision, poly market odds of no rate cuts this year are rising, currently at 24%. For more poly market odds, you can scan the QR code on your screen to go to the Yahoo Finance Prediction Markets Hub, powered by Polymarket. Coming up, it's a big morning for Power Player Chats on Opening Bid. I am live next with one of the giants in the retirement industry and a newly minted IPO company that is aiming to sell you a new sofa this tax refund season. I'll be right back. America is facing a growing retirement crisis. Millions of workers are nearing retirement without enough savings. Pensions have largely disappeared, and fresh volatility in the stock market is adding a new layer of uncertainty for those trying to protect what they've built. At the same time, investors are searching for stable income in a higher interest rate, more unpredictable economic environment. Mike Downing is always my lifeline to get a pulse on the retirement industry. Mike is the co-president and CEO of annuities giant Athene. Athene is a key business inside of Apollo Global Management. I will also note that Yahoo is a portfolio company of funds managed by affiliates of Apollo Global Management. Mike, good to see you. As always, I appreciate it. This has got to be a great time for the business of annuities. The market's getting very volatile. People are questioning if they should own the Mag 7. Like, this is your time to shine.
Absolutely. When you look at what's happening today and where retirees are or near retirees are today, a lot have a ton of equity exposure, even when they're in their 50s and their 70s. So that's huge bets on the equities. And then pair that with what's happening now in the market. Top 10 are almost now 40% of the S&P. That's a lot of volatility at about 10 companies. And then further, it's sector dominant in technology. So it's bet on bet on bet. So volatility is that much more important to protect. And that's where annuities can really come into play, in both blending the opportunity to protect your retirement and still have upside. So a core play in this market are fixed indexed annuities. Fixed indexed annuities guarantee 100% downside protection, so huge protection and comfort against volatile markets, but you still get upside. So if you still want to have S&P exposure or other exposure to the upside, you get that.
This is, we're starting to get, like, this backdrop, I think, reminds a lot of folks that stocks don't go up every single day. And this is a good time to reassess that the 15-year bull market. I mean, how is your business doing over the past, let's say, month with this backdrop being more volatile?
Absolutely, we're seeing more demand in terms of retirees or near retirees looking for protection to protect those savings. So, for example, most people just have enough to make it through. If there's a market downturn a year before you retire or a year after retire, you lose 10 to 20% of your portfolio. You're either going back to work or postponing retirement. That's where annuities can really come in and protect that balance, protect that 30 years of savings, and still get tax deferral on top of it.
What are you seeing? I think the last time we spoke was last September, and at that moment we were expecting rate cuts in 2026. Like, that has totally changed. Now we might get, there's been talk of a rate hike. How has that changed the business of annuities?
It also highlights the other advantage of annuities. So in addition to markets being exposed to equity downside, retirees or near retirees have exposure to rate movements, right? If your bond allocation, those values go down when rates go up. Another core protection that annuities provide is guaranteed return during the duration of the annuity. So you can lock in guaranteed returns.
Are you seeing customers or clients prepare for a recession, and how would a mild recession impact the business of annuities? And keep in mind, like, I was not talking about recession at all 3 or 4 months ago, but these are the reality of the market.
Yeah, we see the annuity business is incredibly resilient throughout market. And in the case of recessions, there tends to be a flee to safety. And what we've seen in just the ramp up with elevated rates and industry volumes about 2 times, a greater appreciation on the part of customers to understand the extra rate and the tax deferral you get out of annuities.
What mistakes do you still see people making when it comes to annuities?
Some of the mistakes we see is people don't understand what it is. I think they think of the annuity that existed 30 or 40 years ago, and they don't really realize how vast the toolkit is. And there's lots of solutions that are in place that are really appropriate for people even in their 40s or early 50s, as opposed to traditionally being more of a retirement play. And
well, how has it changed versus 40 years ago?
yeah, so how it's changed is just the variety of products. So originally they were just a simple X% for 5-6 years, and that was the annuity market. And now what you see are blends and hybrids between principal protection, you still get equity upside, that skews to a younger audience. There's even another type which provides maybe downside protection up to about a 10% market loss, but then you get that much more upside. So it's a way to really sculpt your portfolio and get exposure to have so protect the downside, still have a lot of upside opportunity. And then on top of all that is you get the tax deferral benefits.
The cool thing, Mike, with Yahoo Finance is we are pulling in the next generation of investors to this platform. They watch our videos, they podcast, they're watching me every morning, which I'm very grateful for. But they still trade a lot of tech stocks. Yeah. What do you tell this generation that might be watching this and they're like, and why is Brian spending 7 minutes talking about the future of annuities? Like, why should it matter to them what happens in this space? And if they are interested, how should they initially dip their toes into the world of annuities?
Yeah, start with small, try to buy a small annuity. Don't bet your entire savings on it. Allocate 5 or 10% of your portfolio to an annuity, and you'll see over time the protection it provides. To me, as a younger saver, when I look at younger savers, the volatility is a huge risk in terms of your retirement path, and annuities protect that entirely.
This has been a challenging time in all things private credit. Has that rattled anything in the business of annuities? Are you starting to see any cracks in the business at all?
Absolutely not. The annuities still are an extremely safe play. What makes them exceptionally strong is you have large carriers like Athene, $35 billion of capital, A+ rated, and that's just a huge backstop of protection. And that's what customers are looking for, is that extra protection.
Go out there and get an annuity, y'all. Mike, always good to see you. I'll talk to you soon. I appreciate it.
Thank you for having me.
All right, it's the heart of tax refund season, a time when many Americans traditionally make big ticket purchases for their homes. But this year, that spending boost is colliding with higher gas prices and a growing sense of economic uncertainty because of the U.S. war in Iran, putting real pressure on consumer budgets. So what does that mean for demand in the furniture market? Bill Barton is the CEO of Bob's Furniture. The company's out with its first earnings report since going public on the New York Stock Exchange a month ago. Report was solid, but analysts had a lot of questions on the outlook. Let's get to Bill here. Bill, good to see you here. Feels like we're just down the New York Stock Exchange talking about sofas and recliners. You got peppered with a lot of interesting questions on your first earnings call out of the block. How is the business doing in March now that we've seen this more volatile economic backdrop?
Yeah, Brian, it's good to be with you. Thanks for having me today. Look, the business is doing very well, very strong. We reported a great year last year in fourth quarter, and our sales and our profitability at record levels. We finished the year with a 7.7% comp for the year, and as you're showing on your screen, 2.8% comp sales for the fourth quarter. Very strong momentum, and we're excited that continued into the first quarter. And as we fast forward to March, we're loving the momentum we see today.
Are you still seeing, has the traffic to your stores continued at a strong pace compared to when we talked on IPO day?
Yeah, it's stayed at about the same level. Mm-hmm. Look, there's not really any tailwinds going on in the furniture industry. It's been pretty flat for a while. So the growth that you're seeing from us is really intentional. So our plan is, of course, grow 10% new units every year, and we did that last year. In the first quarter, we've already opened 5 new stores, so we're on plan for 10% unit growth this year, as well as our comp growth. And the comp growth that we're seeing is intentional. We've leaned into driving conversion in our stores and on our website as an omni-channel player. And really what's happening is the consumer's still responding to this wonderful value proposition that we bring to the market.
Bill, I told you this when we last spoke. I'm a Bob shopper. I have all of your furniture in my house, all a very true story. But when I went in there and bought all this furniture, I bought it because I thought and I felt that it was the lowest possible price. Now, you know what the industry calls the everyday low price model. Can you keep prices at these levels when with diesel costs, the cost to transport your goods has gone up so significantly?
Yeah, great question, Brian. And listen, our commitment to the consumer is that we will always be the best value in the market, this value without compromise commitment. And, we've been around a long time and we've seen a lot of types of disruptions, right? Whether it's a pandemic or recessions or, and now we've got this war and gas prices going up. Our merchants leaned in a year ago when the tariffs came out and made sure that we merchandise product at the right prices to maintain that commitment to the consumer to be, 10% below our competitors' lowest advertised price. And we've been able to maintain that even across all of our price tiers, good, better, best. So as we sit here today, we're very excited about the values we have in the market. And as we like to say, value is always in vogue and the consumer's responding.
Bill, the U.S. war in Iran was not on a lot of CEOs' bingo cards this year. It also wasn't in their financial models, to be honest with you. I mean, how much is this rise in diesel costs and other costs because of this? How much more will this cost you? How much more will it impact the business of Bob's from, let's say, a transportation perspective?
Yeah. Well, listen, first off, we're a big player. We have contracts with our ocean freight carriers that are, a year long. We have contracts with our delivery partners. So we're relatively protected on that level. We've seen a few fuel surcharges come through already, but it's pretty muted. But we have a playbook to deal with this. We've seen fuel increases in years past. We know how to deal with it and maintain our value proposition. So we're pretty confident as we sit here today, what we can see ahead of us, that we'll be able to deal with the fuel charges as they come through. And if we need to make changes, we will. But as we sit here today, we're very confident in our ability to deal with these.
Bill, one thing that caught my attention in the earnings release, if I have this right, you focused, like some other retailers, on good, better, and best. And it looked like in the most recent quarter, you saw more consumers navigate to that good part of the equation. Is that the consumer trading down? Is that a sign of a more cautious shopper?
Well, actually, in recent months, we've seen a move into the better category, which we're very excited about. And we think that's in response to our merchants who last fall really leaned in and went back to Asia and our domestic suppliers to really beef up our better and best categories. So in Q1, we're seeing a step up into the better categories. And what's even more exciting is that a lot of it is consumers in the higher income demos. So the fastest growing income demo for us is the over $150,000 household income demo. And they're buying up into the better category, which is very exciting for us.
I see the same thing. I've heard the same thing from Walmart CFO, John Deverini, calling out, a trade down to them, or higher income shoppers coming to their stores. Where do you think you're gaining that market share? Is the new Bob shopper that former shopper that used to go to an Ethan Allen or a Lazy Boy, and they're like, well, hold on a second, these prices over there are just too damn high?
Well, as you know, our strategy is not to be a trendsetter, but a trend follower. So we follow trends in the industry. We bring out our version of these items that are already trending in other retailers, but we bring out our version with more features and benefits at a lower price. And the affluent consumers responding. In fact, all of the consumers are responding to it. And it's been a winning strategy for years for us, and especially in this last year as tariffs have affected so much of the industry. But we're definitely finding that the consumer's attracted to our offerings in the better and best categories.
So you mentioned that traffic in March still continues at a healthy clip. That's good to see. But once that customer is through the door, Bill, are you seeing them trade down? If they went in there to purchase something leather from Bob's, are they now saying, you know what, I'm a little more cautious. I still want furniture. I'm a little more cautious. Maybe I'm going to go for something just a little cheaper on the upholstery front?
Yeah, actually, it's exact opposite. A lot of consumers come in because they're attracted to our good price points, because a lot of what we advertise is our opening price points. And then they see, that, but for a little bit more, they can get so much more benefit at our better and best price points. So we're seeing a trend where they're stepping up to the better price point in a higher proportion than they even did last year.
This looks to be a good tax refund season. Is that a major tailwind to your business over the next few months?
It's certainly a tailwind. We see it every year, and we're seeing it now. It's part of, I think, a number of dynamics that are at play, but for sure, we're hearing anecdotally that consumers are coming in with their tax refund, and they're buying, and they're finding great values at Bob's.
Bill, I like that Bob's doll behind you. Is it a doll? I don't think you told me last time I asked.
Yeah, it's a puppet, and actually, the puppet. This is the puppet that you see in our advertising. Our ads are not CGI; they're stop motion animation, and little Bob is the star of the show for sure. So he sits here in my office with me, and it's fun to have him in my office, and every once in a while I have a conversation with him.
I would do the same thing. Well, good to see you, Bill. Good to see little Bob. Have a great weekend, and we will talk to you soon.
Yeah, thanks for having me, Brian. Take care.
That's it for Opening Bid. Get at me on X at Brian Size. Let's keep the fun combos rolling. You want to talk about Little Bob? Get at me. Julie Hyman is coming up next.
Market Catalyst. I'm Julie Hyman, 30 minutes into the U.S. trading day. And as we take a look at the major averages, we are seeing a little bit of weakness, but not a lot of weakness, right? The Dow is down 170 points right now, about 0.4%. The S&P 500 down about 0.25%, and the Nasdaq's down about 1/5%. Is that, if I told you, absent everything else, that oil prices were close to $100 a barrel for WTI, and there were 109 for Brent, and stocks would be down 0.25%? If I had said that to you, absent everything else, you would probably be surprised. And yet that is where we find ourselves here as we see crude oil prices pushing up, particularly the international benchmark Brent, because of continuing events in Iran. After we had the overnight strike against a natural gas facility within Iran, Iran is now saying that that means that energy infrastructure of what it considers its adversaries could now be fair game. So it seems to be that's one of the things that is pushing these prices higher, and yet stocks are not seeing that much of an effect here. Take a look under the hood of what's going on with the groups in the S&P 500. Energy stocks are up. That's been consistent pretty much over the length of this conflict thus far, and really year to date as well. You've got industrials, tech, and financials that are actually also in the green a little bit today, pulling us down: healthcare, consumer staples, and materials. So, is this sort of a one-to-one? Oil is up. Here are the things that are affected. Doesn't really necessarily look that way. So it continues to be quite interesting on that front. Let's take a look at large cap tech too, because here we are seeing somewhat a more mixed picture, certainly among the largest tech companies. NVIDIA had its sort of analyst and investor commentary yesterday following the GTC product rollout on Monday. Those shares up about 0.4% today. Elsewhere, we've got a little bit of pressure going on in tech. We're going to be watching Micron after the close of trading. But let's talk more about that big picture and that seeming disconnect, right? Joining us now, Venu Krishna, Barclays head of U.S. equity strategy. And Venu, it has been really surprising here. If you look at now this war that began sort of overnight, February 27th, February 28th, and look at how stocks have done. The S&P 500 is down 2.4% in that time. Yeah. And it feels strange that stocks have not come down more, even with oil doing what it's been doing.
And therein lies also the risk. But in aggregate, the market is behaving reasonably consistent with what the experience has been when we have seen flare-ups in geopolitical risk over the last 5 to 10 years. If you just take the example of the Ukraine crisis or the Israel-Hamas crisis a little while ago, that is because most of the time geopolitical risk has been contained geographically, and things have normalized relatively fast. And the spillover effects have been limited. I do think that the risk is incrementally higher now because we've already seen a situation in which the crisis has spread to wider geographical area within the Middle East. And more importantly, it has important implications for the length, which is most important, or the persistence to which your gas and oil prices remain higher, because that will eventually affect the consumer sentiment. It will affect global economic growth, even as we recognize that the U.S. is relatively immune, because end of the day, the U.S. is the world's big, it's a net exporter of energy. Sure. And we actually produce more oil than Saudi Arabia.
But we have to import the kind of oil. We are a net exporter, but we still import oil, the kind of oil that needs to be refined into products that we use, right? And that, in other words, we're not immune from price pressures, of course.
Absolutely. And you're seeing those price pressures at the gas pump already. But I think the way the market is pricing this risk right now, based on what you've said, is that at the index level, things have been relatively calm. But below the index, like we've noted in the past, there's been a tremendous amount of dispersion, a huge amount of rotation, and the kinds of rotations we are seeing is changing. So right now, in the face of this crisis, there's a bid for value, which is what we also like compared to growth at this point. There's a bid for more harder assets-oriented businesses, bid obviously for energy, for materials, and things like that. So I think, on the surface, yes, in aggregate it's contained, but under the surface there's a lot of movement happening right now.
And it's funny, I was looking back at your last appearance when you last came in, which was a couple months ago, and at that point we were talking about headline risk and chaos seemingly in the markets, and we didn't even know what was coming at that point. It's only gotten more chaotic since then.
Right.
And I think your point then was sort of you need to look beyond and beneath the chaos to see what the fundamental case is. Although in this case, I would argue the chaos can spill over if it lasts a while. So at what point do you start to incorporate that more into your models, that we've got oil that is at these levels, that it could potentially have this effect?
Good question. Actually, we are in the process of looking at different scenarios. And what's interesting is, at the base case, I think things look pretty good. Because if you look at the earnings experience of the third quarter and fourth quarter, they've been extremely robust. In fact, fourth quarter, you saw big tech, which has been under pressure generally, increased its overall profitability by almost 150 basis points. They posted earnings growth of over 28%. Similarly, the rest of tech outside of big tech has posted earnings growth of over 22%. And then you look at in aggregate S&P what's happening, earnings growth of almost 12%, sales growth of over 7%, which means a lot of positive operating leverage. And I think the most important is consumption has been relatively resilient and forward estimates have been going up, right? So I think if you look at the underpinnings of the US economy right now, they are relatively robust. And don't forget that now we have the effects of the Big Beautiful Bill, which is positive both at the consumption side and the corporate side. Then you have tax refunds. Typically, there's a flow of money into equities with a lag post the peak of refunds. And if you look at what has been supporting the US equity market right now, flows have been still positive, even though they're running weaker than historical seasonal trends at this point in time. And very interestingly, what we found is it's actually the European domicile funds, global funds, which have been increasing their allocations to the US. In some cases, that's not surprising because the impact on Europe or Asia from this energy crisis, given their exposure to oil and gas, is significantly higher than the US. But to your point, it's well taken that at some point the US will not be immune to a pullback in global economic growth. The question is, what's the magnitude? And our view, and the market's view also, is that in a matter of a few weeks, maybe a month to 2 months, we should come to a much better environment where there's some resolution. If not, then things are going to be tough.
Let me take the other side of that for a moment on a couple of points. On the point about the One Big Beautiful Bill, yes, you'll see that effect, but won't that effect sort of peter out by the end of the year? Thing one.
Sure.
And thing two, the other big engine of the market has been the tech and AI trade.
Yeah.
And as we know, even though it is seeing that earnings growth you're talking about. So I guess it's like, what if you threw a party and nobody came, right? Like Nvidia is the prime example of that, right? It is still showing hot growth, and yet, investors are not joining the party.
Sure,
anymore.
I agree. But let's look at the numbers. Like, let's look at this big tech as a group last year. As a group, they returned 23%. Compared to 17 to 18% for S&P. And that happened at a time when they posted earnings growth of over 30%, but their multiples derated by about 10%. So you still got double-digit solid earnings growth better than the market. So I think if we generally expect that kind of a trend to persist, where you see multiples slowly moderating, slipping down, but earnings growth remaining relatively robust, to the extent that the rate of growth of earnings is meaningfully higher than the rate at which the multiples are contracting, you will have a very good scenario, right? So that's the sort of world we're getting used to. So if you think about where they were trading as a group, they were trading at 31 times forward earnings at the start of last year. At the beginning of this year, they were about 28 times. Right now, they're about 24 times. And NVIDIA is the best example. Partly because we're also hitting against the law of large numbers, because these companies have become so big and the earnings base is so high. But I think critically what has happened is the AI narrative has moved to a different story right now of market trying to pick winners and losers.
Right.
And that's happening at a time where even as they're growing their earnings solidly and they're actually monetizing AI to a large extent, but the fact is there's a significant increase in their AI capital spending, with the result that their free cash flow yield is collapsing. And I think the market has been patient thus far, but now as the free cash flow yield is collapsing and there is no clear sight to when that starts coming down, we think it should start coming down by 28 for sure. You will feel some incremental pressure in terms of the PE multiples the market is willing to pay for this scale of spending. But if you take a step back and say, have you seen this in the past with tech? We have. About 7 or 8 years ago, we saw free cash flow yield come down and multiples remaining relatively high. In other words, the PE multiples didn't come down as much. And that was a good call by the market because that was the investment into cloud. We are still in the middle of cloud transition, and that turned out to be a good investment. The question now is this magnitude of AI spend going to bear fruits in terms of productivity improvement, profit enhancement? Now,
that is the question.
In the short term, like I said, if you look at big tech as a group, just 6 stocks, but which are doing all the spending, most of them, their profitability improved by 150 basis points. So, we are seeing a result in that, but I think the market is a little queasy given the scale of spending and not being able to figure out when will we start seeing that to percolate in the broader economy, which is happening.
Yeah.
AI adoption is increasing. If anything, I would say the biggest shift we have seen in the last 9 months is a broader acceptance that this is indeed a transformative technology, and then adoption is also picking up. To that extent, then you could expect that businesses are going to get more efficient based on the level of adoption, and there's going to be a spread in the market. But this is a complex topic.
There's one last thing I want to ask you about, because it is Fed Day. Can stocks rally this year if the Fed doesn't cut rates? If it ends up not cutting, maybe you get a knock. Maybe you get this feed through from oil. Maybe it's not. Maybe it is something that has more of an effect on inflation, for example.
I think we can. If the reason I'm saying, if you just look at the fundamentals, look at the way the earnings trajectory is unfolding in the U.S. If you're able to maintain that, and multiples have actually come down across the board. S&P overall is trading at 22, 21 times already. Big tech, as I said, has derated. So if you're in an environment in which earnings growth actually improves, as it's expected, even more than last year, then you can have decent returns. I think that a lot depends on the persistence of this current crisis in terms of the oil crisis and its spillover impact on not just inflation, but more importantly, growth.
Yes.
Right? That is going to be the key issue. If growth takes a hit, then actually, your Fed can start cutting, but that's a tougher problem to have because historically, energy crisis does get accompanied by weak economic growth or recessions. We're in a different environment right now, but it all depends on, is this going to be contained as has historically been, or is this different?
Right. Well, we'll have to check back soon and see what's happening at that point. Venu, thank you so much for coming in. It's great to see you.
You're welcome.
Coming up, we're going to take a look at today's trading tickers. You are watching Market Catalysts. Now time for some of today's trending tickers. We are taking a look at General Mills, SoFi, and Swarmer. Swarmer, yes, that's a new name for you. Jared Blickery, markets and data editor, is joining me right now. But let's talk cereal first. Yes, let's talk about cereal first. Apparently not as many people buying it. So General Mills missing Wall Street estimates. Organic revenue was down by 3%. The company, of course, makes Cheerios and lots of other food products. We've talked a lot about how staples have been doing well. But here is an exception to that.
There was a rotation into staples around late last year, early this year. And so, yes, they were one of the best performing sectors. They've fallen off a little bit since then. But let's talk about the quarter here. The quarter missed. Visibility got worse. Adjusted EPS 64 versus 74 coming in. You mentioned organic sales. That was down 3% versus about 2.5%, down 2.5% estimated. Jefferies rates the stock a hold, saying volatility in the third quarter does little to provide clarity. Guidance was maintained, but it leans harder on a better fourth quarter now. So full year organic sales still seeing about drop of 1.5% to 2%. Adjusted operating profit still seeing 16 to 20% down. Bloomberg Intelligence saying third quarter results suggest the turnaround is progressing operationally, but the reiteration of guidance despite tailwinds in the fiscal fourth quarter reinforces the recovery will be slower and more back half loaded than hoped. So pushing out just kind of a rosier expectation for the end of their fiscal year. Underlying positive, investors still need proof on volume, but North American retail organic sales volume that was down 3 percentage points. Pet organic sales volume down 6 percentage points. Mizuho rates the stock in neutral, saying the slope of profitable volume recovery remains key to investor sentiment. So still negative, but maybe improving a bit.
And when you were talking about consumer staples that have done well, General Mills hasn't been participating in that.
Look at the stock here.
I think the stock is down, like 36% over the past year or something?
Let's take a look at the Wi-Fi Interactive here.
It's been pretty straight
there you go,
down.
36%. That is from the upper left to the lower right. So indeed, I like to get a 6-year picture just to see what a stock has done through the global financial, through the pandemic. You can see it had a nice bounce here, kind of started in 2022, which was a bear market. So not surprisingly, it outperformed, but it's been kind of on the downslope ever since then.
All right, let's talk about the next one. That is SoFi challenging a short seller report, and it's considering legal action. The short seller we're talking about is Muddy Waters, which has a pretty it's a well-known research shop, and it is alleging aggressive financial engineering, mismanaged debt. SoFi is fired back with sort of a point-by-point rebuttal to Muddy Waters. Some companies, when they get attacked by a short seller, they hide. They don't deign to reply. But SoFi is taking this seriously and is really digging into some of those allegations.
Let's remember, in 2021, short sellers, a lot of them had to totally back away from their business. So they're a lot more careful now, but more on that in a second. So the core accusation is about accounting and structure, which you were just talking about, Julie. Muddy Waters alleging that SoFi uses loan marks and off-balance sheet structures to make borrowings look better than what they really are, and that it may have about $312 million of debt not recorded as debt. But SoFi, as you said too, pushed back hard and fast. The company called the report, quote, factually inaccurate and misleading, said it reflects a fundamental lack of understanding of SoFi's financials, and said it's considering legal action. One more thing here, Muddy Waters says it intended to begin covering a substantial majority, possibly all of its shorts after publishing. And so this is another, sometimes this is kind of the way the industry works sometimes, but if you're thinking, oh, let me just short the stock now, keep in mind that the biggest short seller here might be buying to cover that position. So
interesting.
Yeah, and you take a look at the stock today, it's up 1.87%.
But that doesn't look like a short squeeze to me.
No, that is not a short squeeze. And indeed, if you go to a year out on the Wi-Fi Interactive, you see it's still holding on to gains of about 48%, but it's well off of those highs there. You can see that more on a 6-month chart, down 37%. Here's the look back into, what is that? Let's do a max actually. Yeah, that is since the IPO. And you can see just kind of down 5%.
Yeah. All right. Speaking of IPOs, let's talk about the last one, and that is Swarmer, the aforementioned. This is a drone company. You can envision swarms of drones. who the guy behind it is Eric Prince, actually.
Blackwater.
And so this went public. And I think it had the biggest increase in a single day since in an IPO, going back a year at least.
It was huge.
Yeah, this was yesterday that
it was something like a 500% pop.
Yeah.
And this company has the whole, a trilogy, AI, drones, defense. That's a lot of buzzwords right there.
Yeah.
But also a huge name in defense, which is Prince. They basically create software that lets one operator of a drone manage large groups of drones instead of controlling them one by one. So hence the swarm name there. Very early stage revenue though. 2025 revenue was about $309,000.
Oh.
So not even $500,000, still deeply unprofitable. 2025 net loss about $8.5 million. Customer concentration risk. One customer accounted for substantially all of their 24-25 revenue, and the company does not expect new orders from that customer going forward. So it's a show me story. But a lot of let's check out the charts real quick on the Wi-Fi Interactive. You can see it's up another 33% today. Here is a max chart from the $5 IPO. It is up 731%. So.
And by the way, it makes software. It doesn't make the drones themselves.
Exactly.
It just
Software,
allows
not
the drones to work in this way, I
Yes.
guess. All right. Thanks a lot.
Thank you.
Whew, so dystopian. All right, let's talk about Lululemon. It is issuing weak guidance for the current quarter and the fiscal year. It's dealing with higher tariffs. It's dealing with declining sales in the Americas. And of course, it's also searching for a new CEO. Calvin McDonald exited in January. It's dealing with its founder, Chip Wilson, kind of poking at the company. Joining me now is Adrienne Yee, Barclays Consumer Discretionary Analyst. Adrienne, it's always great to see you. I love to talk about Lululemon, and it is so fast. I feel like I've been talking to you long enough about this company that we talked when Chip Wilson was there at the company before. What does Lululemon need to do? And do we have a good understanding of what he wants them to do to sort of get back on track here?
Yeah, I think that this is, the case of companies that get very, very large. They become the number one in this space. And it's not that they become complacent, they become safe, right? Because they're now playing sort of not to lose versus to aggressively win. And I think what he wants them to do is get back into that kind of small kind of fighting mindset where they're basically innovating, they're taking risks. And frankly, they're kind of leading the charge on the athleisure space that they frankly created.
That said, I just to linger on the quarter for a minute, the company's overall net revenue was up 1%. In the Americas, it was down 4%. In China, though, they're still seeing plus 20% revenue gains. Is it just that they're smaller there and that's sort of an advantage?
Absolutely. So if you are kind of thinking about kind of what the problem might be, right? In the U.S. market, it might be that we are saturated, right, kind of in that particular space. Not that everybody, right, it's not Nike, so it's not like kind of everybody is buying Lulu, but for the target market in that women's technical apparel, right, we're kind of, at the peak, right? So you're looking for growth elsewhere. One of the other issues that has happened with Lulu is that new entrants have come into play in their space, and they are growing the most and the fastest in the U.S. market. So in the China market, they're small. They are the fighting competitor. They are the kind of one that is growing there. Lots of white space on the landscape there. And it's a new low brand awareness concept, right, in China that's very, very desirable. It's also priced quite attractively there, very differently than it is here in the U.S. So over in China, they raise their prices relative to the U.S. maybe 15, 20% for that market as they try to engage with the customer. Most other U.S. brands, when they go to China, they'll price up 50, 60%. So in the relative atmosphere of China, they are very, very good value, great quality for the value. And it's just a little bit different here with the higher, more intense competitive landscape.
I mean, Adrienne, I remember where you could not get Lulu stuff on sale. It just didn't exist. Remember, we made too much. It was like a tiny portion of their merchandise they would sell on sale. Now they have sale. Now they have their Lululemon Like New, where you can buy certified, pre-owned merchandise, so to speak. So it just shows how far the company has come here in the U.S. market. So what does the next leader of this company need to look like? Is it Chip Wilson coming back? Is it somebody like On Running's Mark Maurer, who Chip is nominated to the board? What do you think?
You know, when you have these types of kind of dislocations, there's a little bit of operational and there's also a bit of the innovation. At the end of the day, what we always say is that product matters, right? So if you did put somebody that was more product oriented, you do want to have that strong foundation of operations to support kind of all the things they're doing. Obviously, there's an activist that has proposed Jane Nielsen. This is very public. And so to the extent that she might be the person, she's sort of more operational, but you can fix that, right? You can fix that by having a very strong product leader, a very strong merchant. We've seen Tapestry do this, very, very well, right? It's a very symbiotic relationship. So I think you could probably have from a CEO-ship either a merchant or an operational person, but it's really that person who strategizes and brings Lulu back down to its roots of innovation, forward thinking, right? And kind of like leading the charge, as I said earlier.
While I have you, I want to talk to you a little bit more existentially, I guess, about retail, because we've seen headlines recently about Eddie Bauer closing down. I was looking at some headlines today about Kohl's closing some of its locations. And I'm sort of fascinated by the idea that, you do have these retailers that end up closing down. In many cases, it takes a long, long time. Lulu's having some challenges. We're not suggesting they're anywhere close to that kind of an outcome. But as someone who really is steeped in the space, what to you is the differentiator between, a retailer that ends up making it and thriving and some of these that have that sort of long, slow decline?
Yes, I love that existential question. And I have, I've been doing this for decades, as you know. And what I would say is the enduring quality, right? And the one that causes companies to miss the mark and go off target, right, out of the bullseye, is they forget that at the end of the day, this is an emotional experience. People talk about experiential retailing. That's fine insofar as you've created, right, a moment for that consumer where they're leaving the store energized, they feel better, they look better. Whatever it is, you have to have an emotional connection to the brand such that when you utter the brand's name, people actually recall that experience. If you can do that, you will have an enduring brand. And I don't think that Lulu has lost that at all. I think for the moment, people are sort of shopping elsewhere. But if you can create that experience, and by the way, you really can only create that experience over the long duration, right, in a store environment. You have the right people, you have people, kind of helping you with the product. And then if you have the great product that makes them feel like $1 million, that's the winning combination.
Adrienne, it's great to see you. Thank you so much.
Good to see you. Thank you.
Appreciate it. Coming up, we're going to keep talking about retail, what Macy's fourth quarter beat says about the future of that company. We're going to hear what the CEO had to say next on Market Catalyst. AI startup Aru, founded in 2024 by teenagers, is now worth up to $1 billion. Yahoo Finance's Josh Lipton spoke to the co-founder and president about how the company is transforming market research.
Maybe, Ned, start by just explaining a bit about your company's mission, the kind of problem you're solving for, Ned. In simple terms, I was reading up on it. It sounded like, Ned, okay, you created sort of an AI system here, and it could replace traditional market research. So surveys, focus groups with AI agents. Am I thinking about it correctly?
Yeah, well, first off, thank you so much for having me on. It's really great to see you, and I really appreciate it. As far as I see it, market research is just the start, right? At the end of the day, what we do at Aru is we simulate human behavior. And if you believe that humans are the preeminent species on the planet, which I think you and I probably both do, you can do a lot with that, right? So some of it might be a much more research use case where you're simulating the behavior and asking someone's A/B opinion on an advertisement. Right, and then you might have the entire other side where someone comes to you with a question about how do I mitigate churn of my customers? And that's a lot larger than just traditional market research, but it's still something that we solve every day with our systems, which is really cool.
Ned, what's the kind of data you're feeding into this AI model?
Yeah, no, it's fascinating. We are in the Valley, right? We're operating at this time when human data has never been more important, right? You have companies building world models and large foundational labs that are spending hundreds of millions of dollars on PhDs to label math problems and all these sorts of things. And interestingly enough, we kind of operate at the antithesis of that, right? When you think about modeling behavior and simulating populations, one of the biggest core principles of what we do at Aru is that humans themselves are not accurate representations of what they actually do, right? People lie. You know, fortunately, both you and I are wearing clothes, and I highly doubt you asked Hugo Boss how much you were going to pay before that jacket, before you purchased it, right? The truth is, at the end of the day, is humans lie. They have biases and all these sorts of things. And when we build these models, both in the way we make sure we're properly generating the agents who we are going to simulate, making sure we have the right race, age, income, all those sorts of things, we never speak to humans, right? We look at things instead that are ground truth building blocks on what makes you and I who we are, right? We might look at a voter file, a credit card purchase history, a statistic on how many people in a certain area have running water. And then on the flip side, to actually model their behavior accurately, we'll look at things like vote counts and click-through rates and sales results instead of things like polls and surveys, again, because they are not indicative of what people actually do. And so we kind of operate at the back of that on a total reversal of using humans and instead looking at the outcomes-based data of what they actually do, which is really interesting.
Can you give us, Ned, like a hard example of your AI model at work, just to illustrate it?
No. For sure. Yeah. I mean, you can go as simple as saying, I'm going to launch a new product, right, for a soda brand. A very public partner of ours, interestingly enough, is Spindrift, right? And they're just putting out this large, initiative around putting forward a still drink for the first time. It's actually a tea, which is something you haven't done before. Traditionally, they're sparkling drinks, much more in that sort of area. What we'll be able to do is simulate an entire population of consumers within the US or whatever interested market they're looking at and identify, hey, let's put these packages in front of it. Are you going to buy this? What price are you willing to pay? What flavors do you want, right? All sorts of things that'll be revolving around behavior to optimize a product deployment. And then even going on there from ads, right? And so on and so forth. So it's like a much, very consumer focused use case. Yeah.
And for the company, Ned, for your customer, is the benefit also, am I saving money? Am I saving time? Can I move faster?
Yeah, I mean, traditionally in decision-making, whether it's around products, for example, or some other sort of area, you're spending months and months and months to come to a conclusion around doing these things. If you're using traditional human research, if you're using traditional strategy consultants, sorts of things like that. And so, of course, there's a massive amount of time where we're able to generate these entire populations in a matter of minutes, right, which has been really cool. As far as like the saving money thing, absolutely. These things have massive economies of scale as opposed to traditional people. The more you ask, the cheaper they don't get. But I had a mentor actually very early on who gave me the advice that you can only save a business so much money, right? We like to tell our customers a value story, right? And so we operate at the opposite end of that, which is, look, we're going to make you more efficient. We're going to do all these things, but we're going to help you make better decisions and grow your business a lot more, which is how I believe you should build an everlasting business. Yeah.
Ned, I got to ask, I had reading that you guys, you're young. I read that you started the company, Ned, just a couple years ago. You and the co-founder, you were something like 18, 19, Ned. Is that I'm curious, is that ever a challenge? Like you're talking to some CEO of some big company, and is it ever a challenge to get him to trust you guys, Ned, to really take the lead on what could be like a mission critical decision and project?
Look, I think it's a great point, right? I just became legally able to drink a couple of weeks ago, and we've been servicing alcohol businesses for the last year. So I think it's an interesting paradox. But absolutely, right? I think it is for every AI company, not just because we're young. A lot of people are putting out a lot of stuff. A lot of stuff sounds really exciting. So what we do at Aru, and the reason we've been able to grow so quickly, right? The business is exactly what you said, just under 2 years old. You're 19 when I started this company. My co-founder was 18, right? My other co-founder is even younger. I'm 21 now, and how we've been able to do this is just by making our value proposition so blatantly obvious in a pilot and in a first interaction with the business that if someone's executive who ends up hearing about that pilot being ran doesn't purchase it, we've literally seen people get fired as a result, right? What we pretty much do at first stages of entering a business is, look, people have sold predictive technology for a while. We say, let's prove it, right? I can try to convince you that magic is real, or I can show you. And so we'll ask a business. If it's a marketing use case, maybe I ask for an ad. And you know what research you ran, you know what decision you came to, you know what actually happened, whether A or B was better, and we'll run it blinded. We'll do it with product deployments. We'll do it with credit card perks, whatever it may be, right? We'll take something that you know about your business without taking any data from you. We'll run a simulation of that population, totally blinded, and prove that we're more accurate than whatever brought you that conclusion in the first place. So it's been this really, really cool thing of being able to prove from the outside in, demonstrate the capabilities of our system, and as a result, move very quickly into gaining the trust of our customers, which has been really cool.
You know, Ned, I read that you and correct me if I got this wrong, that you and your co-founders, you dropped out of college to pursue this, right? And these like, just so viewers understand, these really good colleges like Harvard, Dartmouth. I couldn't get into these colleges. And I just wondered, Ed, do you think maybe we're entering some new era where, companies could be founded by even younger founders than we're used to moving forward? That maybe AI could kind of lower the barrier to entry.
Yeah, absolutely. And don't cut yourself short. I'm sure you'd make it no problem. Yeah, I was at Harvard for about 2.5 weeks before I left, which is quite amusing. But no, I think at the end of the day, in my opinion, like these schools are great universities. It really is just about opportunity cost. Absolutely, to your point, the barrier to entry has been lowered. And I think that makes me as a tech founder think a lot about where do we want to spend our time to make sure our value proposition is so differentiated. To me, that's making sure the product is most usable to the customer, right? I'm in San Francisco right now at a friend's office. We made a very pointed decision to set up office in New York after being an SF for a short amount of time so that we could be near our customers, so that we could understand what a large enterprise actually needs out of a tech platform to use. So, people have always been creative. Right, people have always been able to build things at young ages. I think that has been massively, expanded now with obviously AI making things a lot more accessible. But I think things will be just as hard to build around product and making sure that things are tuned to the usability of customers, because that doesn't have as much to do with AI as much as it does to have with your ability as a founder and as a team to understand what the customer needs. So, yeah.
Ned, it was so great to have you on the show today. Thanks for your time. I appreciate it.
Fantastic. Thank you so much for having me, and have a great day. Really appreciate it. See you soon.
Macy shares are rising after the company topped fourth quarter expectations and issued a strong forecast for the current quarter. Still, Macy's is warning about risks from tariffs and the Iran war, and our senior reporter Brooke DePalma is here now. Brooke, you had a chance to talk to the CEO, so I'm curious what they had to say.
Yeah, well, certainly Tony Spring is saying that all the uncertainty in there is definitely weighing on their outlook. He said specifically that we're in the midst of a lot of uncertainty, and he went on to say that we're going to stay focused on what we can control. Guidance is not a ceiling. He went on to say there's plenty of opportunity for us to do better, but we got to watch and see what happens. All the things I described, tariffs, gas prices, the war, the economy. So all these different pain points, this pressure that's on the consumer definitely weighed on the guidance. He said prudent, maybe not the best word word to use, but just sort of a cautious outlook, a very calculated approach, and they hope to, achieve better than what they had set out for.
I mean, what is the effect of those higher gas prices so far? Are they seeing anything? Are they seeing trade down? Are they saying, like, what changes, if any?
So I asked particularly, I said, is there a direct hit to discretionary spending? He sort of turned it around and said that they're ready for all of, any sort of headwind that might come against the consumer right now. He went on to say that he's had experience with the dot-com bubble burst. He went through the pandemic, through the financial crisis. He said as long as you have liquidity and a healthy balance sheet, they'll make their way through. But what he did say was that this customer is still choiceful. They're still sort of calculating how exactly this will fit into their wallet share. Maybe if there's higher gas prices, then maybe they won't go on a vacation. Maybe then that's kind of good for Macy's, because then maybe they'll end up spending or splurging on fragrance or buying something else. Maybe that was the take that
like,
that
I'm
Tony
not going
Spring
to take
had.
a big expensive trip. Maybe I'll
buy myself
I'll
a
take
bag.
a vacation in my mind. I don't know. I mean, this conversation actually reminds me of the conversation I was just having with Adrienne Yee of Barclays a few moments ago, retail analyst who's covered the industry for decades. And I was talking to her about what differentiates retailers who make it and those that don't. We've seen some examples lately. Kohl's is closing stores. Not to say it's not going to make it, but it's closing stores. Eddie Bauer going out of business and closing stores. Like, what's the difference? And she said it really is about the emotional connection that a brand can build with its customers over years, right? It's not overnight. And so as we talk about Macy's, it gets me wondering, like, at one time I had an emotional connection with Macy's, I feel like. Maybe when I was a kid and I would go shopping there with my mom. That was one of her spots.
For me, that was
JCPenney's.
I'm like, yeah.
But I wonder what that looks like right now, and like how, because Tony Spring has made some changes at Macy's.
Yeah, and keep in mind, Macy's is not immune to these closures that we're seeing from department stores. Right. They still plan to close about 60 to 65 stores in the next 3 years, so that's certainly still underway. But what he has done over the past 3 years is these so-called reimagined stores, where they're putting in more staff, more digital advertising, just more activation. So he was talking a lot about like this prom activation that they're doing. Also, their skincare lines are really working for them. Even young people, 12, 13, 14, buying more La Mer, which is a very expensive skincare. And he was even surprised, but he said that they're sort of, appealing to these moms who are looking at their young teenagers who are wondering, where do I even begin with this skincare allure that they're all going through, right?
You do not begin with La Mer if you're a teenager. I can tell you that. You could slather olive oil on your face if you're a teenager. Most teenagers probably do just fine. Anyway.
Right.
I'm no skincare expert. Disclaimer, I am no skincare expert.
But certainly what he said is that we're sort of seeing this ongoing persistence of this E-shaped economy as opposed to a K-shaped.
What is that? That's a new one for me.
New one, I know. He said some will call it an E-shaped economy. I was like, an E-shaped economy? He said that we're seeing the upper income continuing to tread well. They're continuing to spend. The middle income is looking for deals and they're just sort of staying along, while the low income is just staying persistent and they're just keep chugging along. He said specifically low income pressured, middle income being choiceful, trying to find opportunities to buy. Upper income consumer, though, still confident that
it would be like
buy.
It's more like a W on its side,
right?
than an E to
with
me.
The two, with the W sort of hinting down.
Right, like the one. Okay.
No, I totally get you. I totally get you. But nonetheless, Macy's continuing to push through this uncertainty, and definitely interested to see what happens over the next few years of this brand. It's been almost 2 years since they announced that bold new chapter strategy, and it seems to be working. I mean, right now we're seeing the stock move higher based on these results.
Cool. Thanks a lot, Brooke. Appreciate it. Coming up, we'll take a look at bond market ETFs. We've seen a lot of money come into those. We'll talk about it next. The U.S. war with Iran is putting bond market safe haven status to the test. BlackRock, though, says this cycle favors a more income-oriented exposure, with ETF investments being a viable strategy in more volatile periods. So let's talk to Steve Lapley, BlackRock co-head of bond ETFs. He's joining me now for this week's ETF report brought to you by PIMCO. It has been interesting this year. Maybe walk me through this, Steve, because we have seen, at least in the Treasury market, the Treasuries are now basically back to unchanged on the year as we've seen yields go up. However, bond ETFs are just like raking in the flows, right? We keep seeing record numbers. It's the biggest, it's also the biggest area of the ETF market, I believe, in terms of flows recently. So, is that a disconnect or what's going on there?
No, it's incredible. So we started seeing this when rates normalized. So you go back to the tightening cycle in 2021, 22, and then it was off to the races. Mm-hmm. What's interesting, though, this year we are 40% ahead in flows than we were last year, and last year was a record.
So and it feels like that's happening across the ETF space, but obviously
yes.
especially acute in bonds. What is it about this year? What's going on?
There is a thirst for income that is just unrelenting so far. So there are a couple things going on. If you look under the hood, it's not quite as clean as that. Okay. So for example, the majority of our flows this year have gone into ESCA, which is our 0 to 3 month T-bill fund. So it would be tempting to draw a conclusion from that, like, safe haven. Second biggest flow in treasuries anyway is our broad Treasury fund, GovT.
So across the
there's a little bit of safe haven in terms of the front end of the curve, but then people are also allocating more broadly. You go down the stack, you're going to see allocations then to multi-sector like the ag, to BINC, our active fixed income fund, and then you get into investment grade allocations. I would say the common theme though is quality. The up in quality trade, the quality income trade, that is persisting.
Can I also ask, too, is it also a factor of the absolute boom that we have seen in financial advice? In other words, we've seen a huge increase in registered investment advisors and wealth managers. The wealth channel has grown, and they need stuff to sell to their clients. I mean, it's a little cynical, but that also seems to be going on.
I think this has happily coincided with just an increase in investor awareness. So if you think about it, it is the investor base that we're really seeing come into the market. You guys are very familiar with this. The direct investor base really has discovered ETFs and bond ETFs in particular. And so as an example, we're seeing really significant flows into our I-bonds suite, our defined maturity suite. Why? Through all this noise, you pointed out the 10-year, right? If you look 2 years ago, the 10-year was at 430. You look at last year, it was at 415. But in the meantime, you're pushing below 4%. You're pushing towards 5%. What works in that environment? Laddering. People love just a lock-in yield right out the storm. And those defined maturity ETFs, the I-bonds, are perfect for that. And so investors are responding that way as well.
Interesting. Okay, so what do you think? What are you sort of recommending? There's what's happening and there's what you guys are, maybe they're the one and the same. Maybe people are taking your recommendations, but especially given that we are in a war, that we're in a volatile time, and that there is that safe haven status usually, but it's not that, although it's not quite working that way over the past couple of weeks.
Yeah, there's a lot of noise, right? Yeah. With energy prices, oil, inflation expectations, et cetera. And so I do think you have to have a view. Right, and so if it's uncertain and you want to, sort of wait and see, that's going to be SGov. We've also seen flows into, we have a short-dated inflation product, ICPI. It's a 0 to 1 year inflation product. We've seen flows starting to come into that as well, more than likely because of the, concern that's growing around inflation. We got some strong PPI numbers this morning. But, I think you have these short-dated cash-like instruments, which are attractive. And again, if you're looking to just ride out the storm, laddering is a great strategy with I-bonds. People continue to allocate to things like BINC BINC, just for that broad, diversified income theme. So there's no magic formula. I think you do have to have a view on this, but there are ways to kind of ride out the storm.
I'm going to put you on the spot for just a second because you mentioned PPI, and it made me remember that portfolio management was the biggest contributor to the increase in the services portion of PPI. I was looking at BLS about that. And I was trying to sort of figure out what's going on there. Why, so as somebody who's in the business, What do you think is going on there?
I don't know. That is interesting. I saw that too.
Yeah.
But yeah, no, I don't know. I mean, I think you mentioned earlier just this boom in services and advice, and I do think investors are getting much smarter at thinking about portfolios in general, right? It's not about, oh, I want to buy a fund or a ticker. It's more the sort of orchestra model. How do they all play together, and to get a really good result? We're seeing a lot of conversations like that. So yeah, people are interested in tickers, but they're also interested in how everything can kind of come together in the right way.
Holistic approach, the orchestra approach. Yeah. I like that.
Yep.
I like that analogy. Thanks so much, Steve. It's
Thanks
good to
for
see
having
you. And that's it for Market Catalyst. I'm Julie Hyman. Thank you for watching. We got more Yahoo Finance coming up.